And that should be, hopefully this won't be as, I know I say this every time, but hopefully it won't be as long of a class. Let me pull out the handout. I don't know what I was thinking. I thought we'd already done this. Apparently not. Okay. So we're going to talk about the different types of risks. I don't know if we talked about this before or not, but they're basically, when you're doing an audit, there are four types of risks. Well, actually, there's three types, and then the fourth one is kind of a collected. And so I'm going to go over those first. So these are the risks: the inherent risk, skip these for a while, control risk, detection risk, and then the last one is audit risk. This is a risk for everything. Okay, so these are the four risks we're going to talk about. And the first one we're going to talk about is inherent risk. Inherent risk, oops. Is a risk that a material misstatement will occur. So will it happen? Sometimes they'll add on to that absent of controls. This is basically just, will a material misstatement occur? So no controls involved. Okay. Now, sorry here for a second. When you talk about risks, when you talk about auditing, anyways, do you want the risk to be high or low?
Low.
Low. Yeah, you always want risk to be low. Maybe that's what was causing it. I changed something here. Okay, yeah, you want it to be low. I'm getting fuzzy lines. Yeah, so you want the inherent risk, the risk that a material misstatement will occur, you want this to be low. So and for all these, you're kind of going to see that a low risk is what you're desiring. You want it to be a low risk. So come down here to control risk, same thing. Want to be low. However, here's the control, what the control risk is. The clients let me back up. Control risk, the risk that the client's internal controls will fail to identify material misstatement. And that comes from inherent risk. Okay, so Let me clean this up a little bit. Control risk is that the client's internal controls will fail to identify a material misstatement coming out of inherent risk. So inherent risk and control risk are kind of related in that they're both the client. This is coming from the client. Will the client make a mistake? Inherent risk. And then down here, will the client fail to detect the risk? Fail to identify it, either prevent it or identify it afterwards. So inherent risk and control risk are related in that one's a risk that a material misstatement will occur. The second one is the risk that the controls will not find it. I'm gonna stop. Did we talk about this before? I can't remember if we did or not. Maybe we didn't. Because I'm getting nothing back like, yeah, can we move on? We'll keep going. Okay, so this is by the client. Low risk desired, this is all client-based. This is okay. Here we go. So these two, low risk is desired. You want it to be a low possibility that a material misstatement will occur. You want it to be low that the client controls will fail, will miss it. Material misstatement if it does occur. Okay, now, so inherent risk and control risk. If those two both fail, material misstatement occurs and the controls don't catch it. Either they don't prevent it or they don't catch it after the fact. Then the last hope of catching that material misstatement falls on the auditors. Okay, so the client has failed. The inherent risk if a material misstatement is booked and the controls don't catch it, our last hope is with the auditors that they will detect it. Okay, so detection risk. Risk that the auditors material misstatement okay, so if it gets past the client, last hope is with the auditors. Okay, now again, just like the other ones, we want this risk to be low. And this is auditor based. This is the auditor and they're all the tests that we do and blah, blah, blah. This is what we do to try to detect material misstatement. So this is auditor based. But again, we want it to be low. We want it to be low the risk of the fact that we can miss something. Okay, so inherent risk, control risk, and detection risk. Now, the last one is kind of making up all three of these. What at risk is the risk that an undetected material misstatement will appear on the financial statements. Okay, audit risk. So this is the kind of like the overall risk. You know, what is the risk that a material misstatement will occur? Again, you want this to be low. And this is kind of the overall risk. And this is kind of the risk you try to manage most, is that audit risk. Because that's the one that can bite you. Okay, of all these risks, which ones are controlled by the auditor? Oops. I'll make it even easier. Which one is, there's only one that's controlled by the auditor. What is it?
Detection.
Yep. So this is our audit. This is the audit. You know, when you get out audit evidence, this is what you're looking at. You're trying to detect, any material misstatements. So this is the only one that we can control. Now, the client during the year, they can control these, but even these cannot be controlled at the end of the year. And what I mean by that is, these are the inherent risk and the control risk. Those were in place throughout the year, right? Now, they may have changed them during the year or whatever. But notice something. If you had a control risk in March that maybe you didn't find, and maybe, in April you found it and they fixed it or whatever, notice that that's still a problem. And here's why. You can't jump in the time machine, go back and change that, those transactions that happened from March to April. So even the client can't change inherent risk and control risk for the previous year. Now, going into the future, they can make changes to their internal controls, and hopefully, better training or whatever will reduce the inherent risk. But no one can actually change the inherent risk and the control risk. Now, as auditors, we don't try to change those. We do assess them. So we say, okay, how likely is a material misstatement going to occur? What's the rate? Is it 5%? Is it 10%? Is it 2%? What is it? So auditors will assess those risks, but they actually cannot change the actual risk themselves. They might change their assessment. Maybe they thought it was worse than it was, or they thought it was better than it was. But the actual risk itself, whatever that was, they cannot change those at year end. Can't jump in the time machine and go back and change them. Even the client who controls those can't jump in the time machine and go back and change them. So we really can't change the inherent risk or the control risk. The only thing we can do is the detection risk. Okay, let's talk about the inherent risk just a little bit. And these are pretty obvious. So we have these different transactions. And let's just put them into low risk and high risk. Routine transactions that happen every day. Do you think that would be low? Those would be low risk or high risk?
Low risk.
Low risk. Good. Yep. Yeah, a routine transaction that goes through the normal system, these would be low risk. It's unlikely, for instance, that a cash register at Walmart is there's going to be a problem with any of those transactions. So routine transactions, things that happen every day, those are generally going to be low risk. Non-routine, low or high risk.
High risk.
Yep, high risk. Yeah, something that's non-routine is high risk. So, what does this tell you? When you're doing auditing, do you look at the routine transactions more often or the non-routine? Okay, let's say that Walmart has, they have sales going through the cash register. People come through the store, they buy the stuff, they put it on the belt. You guys know. Those are very low risk. This routine happens every day, millions of times. Okay, so that's a very low risk. But if you have special things, like let's say that they made a special sales to some other group outside, and it doesn't go through a cash register. They work out a deal where someone buys, I don't know, whatever it is, 50,000 garbage cans for whatever they need 50,000 garbage cans for, and then it's done through the corporate headquarters. That's a much riskier transaction. It's not done all the time. People might not know what they're doing because it's not done all the time. It's not done every day. It's a higher risk. So non-routine transactions are the higher risk, and those are the ones you go looking for. So when you're going through the general ledger, you'll see transactions flowing in from the sales journals from the stores. How much did they sell that day, blah, blah, blah. All that stuff will go through routine transactions. You're looking for those things that were entered manually. Someone who sat down and made a journal entry for a sale, a non-routine. Those are more likely to have a problem than the millions of sales that go through the cash register every day. Okay, estimation transactions. Estimation transactions, these can they can be any number of ones. Add debt, depreciation, I'm sorry, I'm drawing a blank here. Valuations. Are these going to be low risk or high risk?
Low risk.
Some of them might be low risk. Actually, some of them, like the depreciation stuff, you can probably, depending on the company, for instance, UPS probably has pretty good numbers on the depreciation for their trucks. They have a bunch of them, thousands of them. And some of them, though, are going to be a little more tricky valuations. How much is let's say that you have a patent for making orange juice, a special way of making orange juice. It's a patent. It's you have the absolute right to make it in this new process, this orange juice. But what is that worth? It's hard to tell sometimes. So these could be low. It's low if you have a bunch of data, or if you have objective data. For instance, valuation. Okay, we have the orange juice patent, but we also have stock in the Ford Motor Company. Well, stock in the Ford Motor Company is going to be easy. You look at whatever it was at year end, the trading at year end, and there's your estimate. So they can be low risk. They can also be high risk. So it really depends on how much data you have. Like I say, patent for making orange juice, very difficult. Ford stock, very easy. Okay, so we'll put both of them for that. It really depends on the data. put that in a different line. Hold on. So it depends on what kind of good data you can get on the transaction. If you can get objective data, that's great. If you can look, if you have a lot of data from the past or something, that's fine. It's when you get into the kind of strange ones that it becomes more difficult. So it depends on the data supporting the estimation. Okay, complex transactions, low risk or high risk?
High risk.
Yeah, high risk because there's more likely to be an error. When something becomes complex, it becomes more difficult. So it's a high risk. And I don't know if I told you this or not, but I was doing an audit one time and they had put in an adjusting entry at year end, for year end anyways, into the books. At some point they decided it was wrong. So they put in another entry correcting it, taking it out. Then they decided it was the right one, so they put it back in. Then they said it was the wrong one, too bad. They did it 6 times. And it was kind of funny because the last time they did it was wrong, but at year end, it was in there right. It was actually a correct journal entry. But it was kind of funny because it happened like in a 3-day period that it was put in, taken out, put in, taken out, put in, taken. It just happened to be put in. They ran the financial statements, and then about halfway through January, they took it back out, and I had to go tell them, look, you got to put it back in for the 7th time because it really needs to be back in there. But it was a complex transaction, and it was hard to figure out exactly what to do with it. So the more complex a transaction is, the more difficult it is. And so you look at those. Another thing that I would do, and now you don't do this when you're auditing the financial statements because it's biased. But one thing I would always do is I would go through the folders that would have contracts when I would go to a place. If you're looking for problems, like I was an internal auditor. Internal auditors, we try to find all the problems. The external auditors don't care about a $50,000 misstatement. Well, internal auditors do. So, we're going through this stuff. And what I would always just do is go to the file cabinet, pull it open, and see which ones had all the wacky stuff, things stapled to it, sticky notes put on it, all kinds of stuff. I would pull those out because that's where you're going to find the problems. And invariably, that is where we found the problems, were in these, very complex things that were going on that had a bunch of alterations to it and all that kind of stuff. So, yeah, the more complex something is, the higher risk it is. So you generally don't look at the routine transactions. You will do some, you'll do the controls on routine transactions, but if you're really looking for the misstatements, a lot of times they are not going through the regular channels. And if you think about it, fraud won't go through there either. Right? If you were going to try to make a fraud to overstate your sales, how could you do it? Well, you could have somebody run through the checkout line at Walmart 10,000 times or whatever and bump up the sale. That's not usually how they do it. It's usually a line entry somewhere that adjusts it. So if there is a fraud, it's not going to go through the routine transactions because it never happened. Okay, so let's go down here. I don't know if this is on the same page or not. Number 5 might be on the second page for you guys. Anyway, there is a formula that we can use to mathematically come up with this. So here is the formula. You take all the risks and you multiply them out. Oops. Okay, so let's see. I'm doing this one first. Hey, keep Get back here, you. Okay, so the inherent risk was 40. Times the control risk, which is 30, times the detection risk, which was 20, and this will equal our audit risk, whatever that is. All right. 4 times 2. Uh, 0.024. So about 2.4% would be the risk here. And notice something about that. Even though these are all pretty high, the overall risk is pretty, what I would say, manageable. That it's, well, first of all, did I get the right number? Is that what you guys got? I think that's right. 2 times 3 would be 0.6. I think that's it. Yeah. So this would be so this would be the audit risk. By the way, I don't know if any CPA firms actually do this, but I do know that they tested this on the CPA exam this way a few times, actually. So it isn't, even though it's kind of theoretical, I think it's something that certainly could be tested. Okay, let's look at the second one on number 5. What would the detection risk have to be to come up with 0.05 or 5% audit risk?
0.25.
That's a question I don't know the answer to. Here, I'll plug it in. It should 0.25, you said?
Yeah.
So 50 times 40 is 0.20. Yeah, that would be it. Yeah, you just put in an X. You could do it like, I guess X is maybe not a good, maybe a D. Oops. So if you solve for D, let's say 0.50, 0.4, and that this would have to equal 0.05. And then to solve for D. Okay. So 0.25, so I'm 100% sure that's right, but 0.4 times 0.4. So you could audit to the 25% level and be very, be very comfortable with it. That it's fairly low. Sometimes you'll see, what is the risk of material misstatement? The risk of material misstatement is just the inherent risk times the control risk. That's the risk of material misstatement. So this would be just 0.60 times 0.20. What is that? 12? 1, 2. So this would be about a 12% risk of it. All right, now let's go to these risks here. I'm going to kind of condense these just to get closer together. Okay, suppose you get a CPA question that says, to reduce the risk of the audit, you should reduce the inherent risk. True or false? To reduce the risk of the audit, you should reduce the inherent risk. Can you reduce the inherent risk?
No.
No, you can't jump in the time machine, go back and reduce the inherent risk. So you can't reduce the inherent risk, you can't reduce the control risk. You can reduce the detection risk. You can also, you might reassess the inherent risk and the control risk. You might say, oh, we thought it was 5%, now we think it's 7 or something like that. But the actual risk itself, you have no control over. So whenever you see a CPA question that says change the inherent risk or change the control risk to do something, you can't do it. Your assessment of it may change, and they may ask you questions about if it does change. If your assessment risk increases, what happens to your audit risk? So if your assessment of the inherent risk, suppose it increases, you thought it was 8%, now you think it's 12. What happens to your audit risk? Does it increase or decrease?
Increase?
Whenever a risk increases, your audit risk increases. You want all of those risks to be low. If one increases, they all increase. Now, here's one that's not as intuitive though, and that's when it comes to detection risk. Detection risk is the only thing that we have control over. Okay, so let's say that you have a company that's doing very, very well. They're doing fine. They have no problem you coming in and looking at their books. In fact, they're proud to show you their books because they're doing so well. Are you going to increase the detection risk? Well, in other words, make it more likely that an error could get through, or are you going to decrease the detection risk? And I know that, there's always that, implication of, gee, we should always decrease the detection risk. But you gotta remember, that costs money. How do you decrease the detection risk? You do more tests, look at more things, it costs money. So it's not just as simple as saying, always decrease the detection risk. So if a company's doing very well, are you going to increase the detection risk or decrease it? What do you think? So detection risk, this is the only thing that you have control over. That's this one. Company's doing really well. Is the fraud risk going to be higher or lower for a company that's doing very well?
Would it be higher?
You're going to make the detection risk higher because you're going to give them a little more slack, because it's probably unlikely that they're doing, if they're having a record year anyways, it'd probably be unlikely that they're, that they would have a reason to create a fraud. When you tighten it up, it's for companies that are riskier. A company that's riskier, a company that's going bankrupt, they have a big incentive to cook the books, because if they cook the books, maybe they'll get the loan and they'll get another year or two out of the company, or maybe turn it around, another year or two, whatever. So a riskier client, you decrease that detection risk. it's more likely something bad is going to happen. If a client is very stable or doing very well, they have much less incentive to create a fraud. And if you're wondering, well, why am I talking about fraud so much? Notice what happens when a fraud happens to our equation down here. I'm going to copy this and move it up. This is what it looks like when there's a fraud. So fraud is when they do it on purpose. Oops. You need to be in lowercase, I want it to be in uppercase. Fraud. You gotta say it just like that. Okay, notice if they're cooking the books, oops. What's it doing here? Who's working this keyboard? Notice these both go to 100%. So basically, if they're committing a fraud, one of the reasons why it's very difficult to find fraud is because these both go to 100%. And if you don't realize that they could be making, perpetrating a fraud, if you're doing this detection risk to a normal level, like 25%, there's a 25% chance. Whatever this is, this becomes the audit risk. So you are not only the last one to catch it, it's all on you to catch it because it actually has occurred. They probably covered it up, and it's all up to you. So this is what happens when a fraud occurs. The inherent risk goes to 100, and so does the control risk. They've purposefully made a material misstatement. They've purposely had the controls not find it. So frauds are very difficult to find because of that. And if you're not aware that's going on, you might be auditing it to a level that you shouldn't be. You should be auditing it to a higher level. So fraud is in fact, that's why fraud is different than regular material misstatements. A regular material misstatement will often get caught. If you have it, here we go. Okay, here's a little toy car. Let's say that I buy this toy car for the store, and instead of it costing whatever $1, I put in that it costs $50,000. Someone's going to catch that. A big material misstatement. If nothing else, it'll hit somebody's budget. They'll say, "What is this? Why are we paying $50,000 for a toy car or whatever?" Oftentimes it gets caught if it is an honest error. Oftentimes they'll get caught. Not all the time, but most of the time they will. So if you do have a material misstatement, it's at least a good possibility that it's a fraud. And that makes your audit all the more difficult because now you have to audit to a very tight detection risk, a very tight auditor's risk of, your detection risk and your audit risk are exactly the same at that point. So you have to, audit down to 2% or 1% or whatever it is. So that's why fraud is, that's why fraud's a real problem. And back when I was going through, they said, "Oh, it doesn't matter whether it's fraud or a misstatement; they're all the same." And they kind of came to realize, no, it's not the same because someone's actually trying to cover it up. Okay. Evidence itself. Sufficient appropriate evidence. So sufficient appropriate evidence, sufficient could be changed to, is it a quantity? Hey, someone keeps turning on my, and appropriate is a quality. So you have to get enough quality evidence. Another way of saying it is you have to get good evidence. And you say, oh, okay, enough good evidence for what? To support an opinion. So you have to get enough good evidence. Sufficient is a quantity, and appropriate is a quality of evidence. If you get enough good evidence to support your opinion, and if you can't, then you give a disclaimer. If you can't get enough of this, it's a disclaimer. Okay. Suppose you're looking at taking an audit that you don't think you can get enough sufficient appropriate evidence. What do? So someone says, "Hey, can you come audit my stuff?" And you go there and you realize that they're doing everything with cash. They're not writing anything down. What do you do at that point? So suppose you go, you're looking at taking this audit, and you don't think you can get enough sufficient appropriate evidence. Do you actually take the audit?
No.
No. Yeah. If you can't get sufficient appropriate evidence, if you don't think you can get sufficient appropriate evidence, you should not take the audit, because an audit depends on that. And if you can't get it, you should decline the audit. So the sufficient appropriate evidence, this is actually it almost goes to the core of auditing. Okay, and this I don't know if we talked about. I think we may have talked about this. We rank the evidence based best, medium, worst. The best evidence, we'll make that green. I'm going to do all these. Did we do this before? So best evidence is held by a third party, created by a third party and held by a third party. So someone other than the client has this evidence. Okay, medium evidence. And I'll give examples of these in a second. Medium evidence, we'll make those yellow. They're held by a third party. I said that wrong. They're created by a third party, they're held by the client. This is all part of my telling you wrong things part of the class. The worst evidence is stuff that is made by the client and it's held by the client. This is the worst evidence. And it's not lined up. That's how bad it is. Okay, so let me give you a medium one and kind of talk about it a little bit. Okay, let's say that we have a bank statement that the client has. Okay, so the client gets a bank statement. Every month they get a bank statement. So at the end of the month, they get a bank statement. The client has it. So let's say this is IBM. IBM gets their bank statement. Now, as an auditor, you can look at the bank statement, and it's made by a third party. It's held by the client, right? The bank statement went to the client. Every month they get a bank statement. Okay. One of the things we do with evidence is we try to move it up to a better category of evidence. How do we do that? Well, in the case of the bank statement, we say, okay, let's have your bank send the bank statement directly to us. you don't have a chance to get the bank statement and alter it. So if you're IBM, and this is a very common, this is every audit firm does this. The bank will send the bank statement directly to the auditors. We've taken that same bank statement that was medium evidence and then moved it up to the highest level of evidence, the best evidence. So this would be a bank statement. Directly to the auditors. Messed up my alignments here. So this is us trying to move up evidence to a higher level. You know, a bank statement to the client is medium. A bank statement directly to us is the best evidence. So we're always trying to move up, you know, evidence up this ladder. Any question on that? So the stuff that's on the outside, people who are not in the company, unbiased evidence is the best. Stuff they sent to the client is second best, and then the worst evidence is the stuff they made themselves. Okay. And we'll kind of go through these and we'll talk a little bit about them. I don't know if we've even talked about all these before. Okay. So a customer purchase order. This is a customer that sent a purchase order to your client. So the customer would have been a third party. They sent the purchase order to your client. So this one would be medium. Okay, so that purchase order gets sent to the client. The client makes out a sales order. So they take the customer's purchase order and they make their sales order. So if this is IBM, IBM makes the sales order. What kind of evidence is IBM's sales order? A client sent them a purchase order. The purchase order, they made their sales order. Is IBM's sales order the best, medium, or worst evidence? So IBM made the sales order, and IBM is holding the sales order.
Medium?
Actually, it's the worst. They made it and they're holding it. And if they're going to do a fraud, you know, they would, you know, you could just print one of those, you know, up without a purchase order. You could just print up a sales order. Okay, how about the pick list or packing list? Who made it and who's holding it?
It would be worst.
Yep. Yeah, anything that's generated inside the company is going to be the worst. Sales invoice.
Medium?
Probably be the worst. This is when they make up the invoice, and notice that they could make up a fictitious sale order, make up a fictitious pick list, and make up a fictitious sales invoice, and say, "Here you go, there's our sale." So you got to be careful when you can see a document that, you know, by all appearances looks very official, invoice, sales order, all that kind of stuff. You got to think about this ranking. Who made it and who holds it is very important. Now, bill of lading and proof of delivery. We haven't talked about those, but hey, look at that right underneath there. Bill of lading, proof of delivery. Okay, so here's what here's what a bill of lading is. A bill of lading is when you're actually shipping something. Notice what a weird transaction is when you ship something. We don't think it's weird because we see it every day, but you're taking something that you own, and you're giving it to this other person. Now, they don't own it. So you're transferring the goods, but not the title. They don't own it. You know, it could be the customer that owns it, or you still own it, or whatever it is. But it's a strange transaction. You're taking something you own, you're giving it to this other party. They say, okay, here it is. You have possession of our goods, but you don't own them. The other party says, oh, okay, I am taking these goods from you, and we're going to have this bill of lading. And this bill of lading is an agreement as to what you have given them. Okay, so the bill of lading is, hey, we put these toys on the truck, and they gave us this bill of lading, and both parties will have it. So the shipping company will have it, and so will the client. Now, the client's shipping bill of lading is medium evidence, because they were involved in making it and they're holding it. But you can also get the bill of lading right from the shipper, which would be the best evidence. It's a third party. And what you can do then is take that bill of lading, whatever is listed on there, and they'll have a list of the items on there. They usually don't have costs or anything like that, prices, but you can actually match up what was on that bill of lading with the sales invoice. And if they match up, then that sales invoice now is more persuasive. Okay, there's a sales invoice for what was actually put on a truck at some point and shipped away. So it's this agreement. A bill of lading is an agreement, but it's an agreement with a third party, and you can get those documents from the third party. So a bill of lading, let's see here, transfers the possession of the goods, but not the title. So it does not give the title. And it'll have a number of them, descriptions and weights and all that kind of stuff, signed by both groups. Seller and buyer addresses. The prices are usually not on there, but you can actually get the prices from the, well, you get it. Actually, there's two other places you should look for the prices. If there is one, the purchase order should have the prices. And the sales order. So you can verify the prices. You can take these so what's on the purchase order and the sales order, the prices should match up with the goods that were shipped. The number of the goods and the description, weights probably don't really matter. But you can then look back at the purchase order and the sales order. The purchase order and the sales order it's good to look at the prices. Those prices should match, but the quantities may not. So the prices should match the sales order and the purchase order. But the quantities may not. It might, they ordered 10 of them, we only had 6. Okay, well, we sent them 6. So the sales, the quantity on the invoice may not match up with the purchase order. Maybe we only sold 6 to them. So when we look at the, and sometimes you'll see it written mistakenly in some of the some books that the purchase order should match the sales invoice. Only the prices are usually what you're looking for, because they may have, they may have shipped like 15 things and the customer ordered 22. They may not all have been shipped, but you're going to match up what was ever shipped should match up to the quantity on the sales order and the prices. And the prices should match the purchase order. At least if prices are given on the purchase order, which they should be. Okay, proof of delivery. We kind of all know what this is. If you buy something from Amazon, they'll send you the picture of it, Here, we delivered it. That's a proof of delivery. And we took a picture of it. Here it is on your porch, and I always look at it, and it's always like the neighbor's porch, and I have to go over to the neighbor and get it. But that's a proof, basically proof that, hey, we set this here. That's all a proof of delivery is. Now, you think that the proof of delivery would be the actual key one here, but the bill of lading is actually more persuasive. Bill of lading tells you at least there was an attempt to make a sale. Whether it arrived is kind of out of the client's thing. IBM makes a sale, they send something to somebody and it doesn't get there. Well, if you get a bill of lading, it says, look, they actually put something on a truck. Here's the bill of lading. The two parties signed it. So something was on the truck. There was the effort made. And at that point, it probably becomes an insurance issue. So there'll probably be a collection on the insurance. So it probably isn't that the sale won't be occurring, because you'll probably just get insurance money back, or at least part of it. So bill of lading is actually the most important one here. And this is the one we really look to, because this makes it that there was an honest attempt to ship something. Whether it got there or not is kind of out of our control. Okay, so bill of lading and proof of delivery. What are those? Best, medium, worst. I'll give you a hint. It could be two of them. What kind of evidence is bill of lading?
Bill of lading would be the best evidence.
It'd be best evidence. You could certainly get it right from the shipping. The shipper, you could get it the best evidence. If you're looking at one that's held by the company, it could be medium also. But again, you can always move it up to best by contacting the shipper and saying, hey, we need the bill of lading for this. So it could definitely be moved up. If you're just looking at it from the client's bill of lading, be medium, but it could also be the best if you go right through the shipper. It's easy to do. Okay, let's take a break here. We'll finish this up and then we'll do the multiple choice questions. All right, let's say stop here. Okay. Wait, let's say be back. 7:10. Okay, let's go ahead and get started on this. A management letter. At the end of an audit, the auditors will present a letter to management. And the two people that need to sign it are the usually the CEO and the CFO, the Chief Financial Officer. So CEO and the CFO will sign. Oops. And the letter, I think I gotta say this. In the letter, management takes responsibility for the financial statements and the internal controls. And this happens at the very end of the audit, and they must sign it. And it's basically an acknowledgement that they are responsible for the financial statements. I still wonder why this lighting in here seems so moody. It's like a airport lounge or something. It's really not like that here. It's not this dark. But anyway, but anyway, so at the end of the audit, and you'll have everything in there will be stuff that management told you that you relied upon. Will be in there, and you'll give it to them to sign it. Now, it does not replace gathering evidence. The management letter does not replace audit evidence. So you can't just say, "Oh, we're not going to do that. We'll just put it in the letter." So it does not replace audit evidence. But what it does do is it reminds management that they're responsible for it. And if they don't sign it, they generally get a disclaimer of an opinion. Because the idea is, why wouldn't you sign it? You know, that, okay, you're taking responsibility for the financial statements and the internal controls. If they refuse to sign it, it's not necessarily that it's extra evidence, but if they refuse to sign it, it's evidence that there is a problem that you don't know about, or else why wouldn't they sign it? So it's basically putting those two people on the hook for the financial statements. And again, if they don't sign it, generally they get a disclaimer of an opinion. And it really doesn't matter what the reason is. You know, someone says, "Well, I've only been here for 3 months" or something. Either you sign it, you know, you've been here 3 months, you're chief financial officer, the financial statements are your responsibility. Either you sign it or else you get nothing. So, yeah, it's It's one of those things that needs to be done. Lawyer letters. The kinds of letters we ask about significant legal. Claims related to the client. The client, the lawyer letter should corroborate what the client has told you. So the first person you talk about legal stuff is the client, and the lawyer letter is basically it should, at least for those things that are material, it should mirror what the client has told you. So your first thing you do is you go to the client, say, any legal issues. They say, yeah, we're being sued. It'll probably cost like $20,000. When you contact the lawyer, you might ask them about that lawsuit, and if they say, hopefully they'll come out and say this, we estimate around $20,000. But if they say, yeah, it's estimated at $200,000, well, then there's a problem. So, you're really looking at the lawyer letter, not so much to replace what the client has told you, but to corroborate or refute what the client has told you. But first you go to the client. Okay, external confirmation. Okay, accounts receivable. So accounts receivable are very susceptible to being a fraud. Let me show you why. So here's the journal entry for accounts receivable. So accounts receivable are susceptible to fraud because there's no cash involved. If we were to try to cook the books and put sales on the books and say, well, this is for cash, well, the auditors will see right through that. They go, okay, well, it's $50,000 of cash. It's not in your deposits. It's not in the bank statement. Your cash is off by $50,000. So if you're going to cook the books and increase the sales, putting it into cash would be about the stupidest thing you could do. So, fraudsters are not idiots. And so they say, okay, we'll put it into accounts receivable. Well, those accounts receivable are the worst evidence. Why are they the worst evidence? The invoice, which probably triggers it, is made by the client, is held by the client. So you can't go get the bill of lading, and that is one way to check accounts receivable, is to look for a bill of lading and match it up to it. But you can also contact the client's the client's customers directly. So you go to, let's say you're at IBM. IBM has their own customers. You can send out confirmations to their customers, IBM's customers, to see if if they're real still. And then the confirmation will basically say, do you owe IBM $50,000? And they come back yes or no. If it's no, then say, okay, well, what do you owe them? What's what's wrong and all that kind of stuff. So these confirmations are to check on accounts receivable. So these are the problem. Okay, negative confirmations. Should have done this the other order. I'm going to talk about positive ones first. Positive confirmations. Positive confirmations. All positive confirmations must be returned. Okay, so if you send out 100 of them, you got to go get 100 of them back. So positive confirmations. Every single one of them has to come back. Now, which confirmations are you more interested in? The ones that are okay or the ones that are not okay? We'll call them good ones and bad ones. Which ones are you interested in for the confirmations? The good ones or the bad ones? Are you interested in the confirmations that say, hey, everything's okay? Or are you ones that say, no, here's a problem? Which ones are you more interested in? The good or the bad?
The bad ones.
Yeah. Negative confirmation says only return the confirmation so if there's not a problem, you don't do anything with it, throw it in the garbage. If there is a problem, you got to return it. Tell us what the problem is. So, down here, if there's a problem or not, they all have to be returned. Up here, negative confirmations, only return confirmation if there's a problem. Okay, so the question is, we have two of them, which one's better evidence? There's a problem with the negative confirmations. You send out some confirmations and you don't get them back. Does that mean everything is okay? There's a problem with the negative confirmations and that you're not sure. It may have been sent to the wrong address or it got delivered to the wrong address. Maybe you sent it to the right address, but they dropped it off at somebody else's mailbox. The client never, or the customer, IBM's customers never got it. And of course, you're not going to get it back because whoever they gave it to said, what is this? And threw it in the garbage. Or you send it to one of their customers looks at it and says, oh, they're a bunch of idiots. Goes up, throws it in the garbage. Oh, I just hurt myself. Throws it in the garbage. You don't know what happened necessarily. So you really can't make any judgment based on what you don't get back. You can only make a judgment on what you do get back for negative confirmations. Positive confirmations, you get all of them back. You'll know exactly what happened. You call up the people. Did you get it? No, I didn't get it. Oh, okay, you sent them another one. Did you get it? No, I didn't get it. Do you have a fax machine? Okay, go over to the fax machine. I'm going to fax it to you. So you can, if there is a problem with the positive ones, it's tracking them all down. And you send out 100, you get 87 back. You make some phone calls, you get 5 more back. You make some more phone calls, you get 2 back. And then there's ones that you just have to. So the positive ones are much more time consuming and they're much more expensive. It's better evidence, but it's more expensive evidence. Okay, so let's take a look here. Now, so that's what confirmations are, external confirmations. Let's go to US standards. They are required. Are US standards? International standards, they are not required. So US standards say you have to, you must do these unless you have a really good reason for not doing it. You know, maybe you only have one customer or something like that. But generally speaking, you're required to do those for US standards. International standards are a little more lenient, and they say they're not required. You can, you know, instead of sending out the confirmations, you can look at the bill of lading, you know, that sort of thing. You do not necessarily need to send out confirmations. US standards say they are required. So this is a difference between the two. Okay, so which type of confirmation would they use? Let's say that the auditor would be equally satisfied with each of the following types of confirmations. So the negative confirmations, these ones aren't as good, so we need a lot more of them. Positive confirmations are better, we need fewer of them, but they cost more. Which should we use, the negative ones or the positive ones? You'd be equally happy.
Negative?
Costs less. So if it doesn't, you know, if you're still happy with it, no matter $1,500. Oops. And these would cost $2,000. So which one would you choose? You'd choose the negative ones. They are cheaper, and you'll be just as happy with them. You have to send out a lot more of them, but you'll be happier with them because you don't have to hunt them down. So from this, do auditors always get the best evidence? Will auditors always use the best evidence?
No.
No, it might be too expensive. And two, remember, it's not just your expenses. Usually there's a charge, you know, your client gets charged, and you do have a duty to try to keep the overall cost of the audit down. And so, yeah, you don't always pick the best evidence because it's just too expensive to do it. Okay, working papers. I think we talked about this. Working papers. The auditor's evidence it supports their audit report. Oops. Opinion. So it's kind of like the backup. It's saying, okay, this is why we think that, you know, that our opinion of whatever your opinion is. So it's the auditor's evidence that they did that they did what they were supposed to do on the audit. So that's the working papers. I think we talked about this. I can't remember. Auditors own the work papers. So auditors own the working papers. 1 second here. And you know, so you might have a client that thinks that they own the work paper. Well, we paid for the audit. I want the work papers, though. That you know, they don't own the work papers. Now, if there's a problem that they need a certain work paper for, you know, like for instance, if there's an error in an account that they want to correct it, you can give them the information about that, but they don't look at the work papers. And Sometimes the work papers have confidential information even in the company. That maybe you investigated somebody who was committing a fraud, they thought was committing a fraud, but you look into it and there's nothing there, they weren't committing a fraud. Well, you don't want that to get out, that kind of misinformation about somebody getting out anyway. So they don't get the work papers, the auditor keeps the work papers. Confidential nature of the work papers. The auditors own the work papers. But the information in the work papers confidential. So even though you own the work papers, that doesn't mean you can, go post them on the internet or anything like that. It's confidential information. Okay. Retention of the work papers. AICPA, 5 years. So this is for non-issuers. PCAOB, 7 years. So you must retain the work papers for 5 years by the AICPA standards and 7 years for PCAOB for publicly traded companies. Changing the work papers documentation after the release date. AICPA, 60 days. PCAOB, 45 days. Kind of cleaning up the work papers, they would call this. And this is for things to be removed from the work papers. You can always add stuff to the file. You cannot take anything out after 60 days for the AICPA and 45 days for the PCAOB. So the work papers, you can't clean them up. Any like dead ends, any things that were nonsense, like we talked about if you had a like let's say you looked into a fraud, someone said, oh, this person's embezzling money, you go look into it, nothing, there's nothing there. You might just take that out completely, because why have that hanging around? It's a false claim about someone's integrity or whatever. So you go through and you clean up the work papers, take out all the stuff that it doesn't really apply, the work papers. But after 60 days for the AICPA and 45 days for the PCAOB, you cannot remove anything after those dates. So you can't go in and start pulling stuff out, thinking you have a lawsuit or something coming in or changing them. So it's 60 days and 45 days. You can always add stuff to it, and you will. As time goes on, you get more information about the client. Oh, they merged with this company, they did this, the CFO left, whatever. You can always add stuff to the work papers. You cannot take stuff out after those 45 and 60 days. Any question on that? Okay, I think you guys should have gotten the multiple choice questions. I asked that wrong. Is there one that did not get the multiple choice questions? I sent them in an email. Okay, I am going to start a poll. Oh, made it look worse. Yeah, so let's go through these and just go through and put them in the multiple choice into the poll, and then we'll go through the solutions to them. And at the end of class tonight, I'll go ahead and send out the uh, exam for chapters 5 and 6. And I know some of you have already turned it in. The sampling one is due. The sampling exam, I think, is due this Friday. I think it's due this Friday. Is there anyone that did not get the sampling exam? Okay, I'm assuming that. Your stunned silence. You all got it. So okay, so let's go ahead and do these. So go ahead and do these, and put them into the multiple choice. I think there's 10 of them. Hey, who did the spacing on this thing? Seriously, did I send it out like that? Sorry about that, guys. All right. And this will be for the extra credit points we added onto the test. Okay, let's go ahead and go through them. I just had a sneezing fit here, so I look a little. Okay. Tracing from source documents forward to the ledger most likely will address which of the following completeness. Existence would go from the ledger to the source documents. So source documents are what triggers, stuff to go into the ledger. So this would be for completeness. All right, let's go to the second one. I'm so sorry, Mike. I'm allergic to something down here. Okay, which of the following include the auditor should reject an engagement? Yeah, it's unlikely to find evidence. If you can't find the evidence, there's no reason to do the audit. You'd be wasting your time and money and your client's time and money, which is a no-no. That's a technical term, by the way, a no-no. Okay, 3. Ooh, this one's up for that. Test the existence. An auditor sample from B. So existence, if it shows up in the ledger, we want to see if there's source documents that have it. That support the ledger. So existence would kind of be going backwards from the ledger back to the source documents. Yeah. All the rest of those are going forward from the source documents. So existence is, does it exist? Let's see. The auditor faces the risk that an audit will not detect a material misstatement of the financial statements. Yeah. Substantive tests. Yeah, these give the dollar amounts. And testing the internal controls, while we do that to reduce substantive testing, they really don't tell us if it's misstated. So test of controls are yes/no tests, and they really don't say whether it's off by anything. And you can have bad internal controls, and the financial statements can be fine. So even if there is a problem with the internal controls, it does not necessarily mean that they are misstated at all. But you don't know from the tools. Don't test the controls. Okay, let's see. 5. Yep, good. You're gonna look for procedures. Yeah, strange fluctuations. You look for plausible relationships for analytical procedures, and they point out where to look. They identify it, but they don't necessarily prove that it is misstated or not. But the identification of the problems are, almost all of them come through analytical procedures. Something like 95% of fraud is found this way. I should say identified. Some people say 95 and 99, whatever it is. It's high. And these are required because they're so high. Okay, 5, 6. Which statement is correct relating to the potential successor auditor responsibility communicating with the predecessor auditor in connection with it? Yep. Successor auditor does have the responsibility. Successor auditor must be kind of other. No. So legal, successor auditor need not contact the, B. To test for unsupported entries in the ledger. So this would be for an existence. Let's see. The testing direction should be from ledger. Good. Eight. The auditor selects a sample from the file of shipping documents to determine whether invoices were prepared. This test is performed to satisfy C, completeness. So did they bill all of them? And you might say, well, of course they billed all of them, right? They want to make their sales look bigger. Not necessarily. If they don't want to pay taxes, they may be reducing their revenue so that they don't pay taxes. So yeah, sometimes especially for smaller companies, you don't really know which way they might go with it to either overstate income or understate it, because they might be understating it for taxes. So to see if they've, see what was shipped and make sure that there was a sale made for it. It'd be a completeness test. This one's tricky, but you guys got it. The predecessor auditor has no responsibility to contact the successor. The successor must contact the predecessor. Sorry, my camera's in the way, and so I'm taking it around trying to get. Okay, so the successor, it's all on the successor to contact it. And yep, 8K. The 8K could be for a lot of things, but one of the things is successor auditor. Okay, well, you guys missed one. That's not that bad. Very good. Okay, I will. Well, first thing I want to do is, I never shared the poll with you guys, did I? I'm an idiot. Can you guys see the poll or no?
No.
It's not giving me the option to share it. Oh, here we go. I'm sorry. Yes, it gets very, if I do stupid stuff, just you put it in chat or something. Hey, you're an idiot. Let me know. Hey, you're an idiot, Dad. All right. Yeah. So these were the only one that was the first one. The only one that was. What was the first one? Oh yeah, the completeness, not complete. And by the way, they kind of when it comes to the testing, which way the two that get hit the most are the completeness and the existence. And I think I told you this before. That it goes from when you do testing, you virtually always do book to floor and floor to book. It could be book to source documents and source documents to book, but they always call it book to floor or floor to book. So you test from the financial statements to the general ledger back to the floor, from the floor to the general ledger to the financial statements. Those are the two directions you usually go. Okay. So anyway, those are the. I'll put them. I'll scroll through them here so that they're on the video. You can see them. Okay, I'm going to stop sharing. I don't like sharing. I hate it. Okay, and now I'm going to save it. And so what is this, week 12? All right, so you guys get the extra credit points for that. Okay, so what happens next? Later on tonight, I'm going to send out the test, the chapter 5 and 6 exam. It's due a week from Friday. So I'm going to send that out after class. I'll send it out as soon as I can here. It'll probably be like 9 o'clock ish. I'll send that out. I just want to check and make sure it's appropriate. But so yeah, so I'll send that out, and I know a number of you have already turned in the sampling exam. So the sampling exam is due on Friday. Any questions?
We don't have class next week, right?
Oh. Let me look at the calendar. Wait a minute. You are right. We do not have class next week. Okay, well, let's change this to. I'll still leave the due date. And by the way, you guys don't worry about it. If you turn in stuff late, it is late. So we'll say no class next week. Okay, so what is that? The 22nd. So the 28th will be the next class. Okay. Well, thank you for letting me know that. That's I would have been. I've been sitting here. Where are they? They're actually reading calendar. Oh. All right. Well. Okay. Now it's 8 o'clock. We gotta go. Okay. So I'll send out the test as soon as I can. Probably like around 9 o'clock. And no class next week. And I will see you guys in 2 weeks. Okay.
Thank you.
All right. Thanks, guys. See ya.
Thank you.
Have a good one.
Good night.